Planning for profits. It's wise to consider abandoning any part of your business that doesn't produce profits. Many successful builders move in and out of markets as required by circumstances. But you must be able to predict the effect of any change before you make it. Your books and records will be invaluable in helping you make this decision. If one type of work that you do, or an area where you do it, is losing money, that saps profits from your total business. It drains off time, money, and assets while dragging down overall performance. For example, assume that your operation is divided between 3 types of work. You suspect that 2 of these are money makers, and the third is a profit drain. Your total yield may be cut in half if the figures look like this. The combined yield of work A and B is 6.5%. Because work in the C area is losing money, it drags the total yield down to only 3%. But look carefully at the figures before you start turning down any work. Fortunately, unlike new work you might like to get into, you have plenty of your own figures to help you make your decision. First, you need a profit and loss statement by type of work. But the net results by business type don't really tell the whole story. Avoiding low profit work doesn't necessarily cut your overhead proportionately. There are fixed overhead costs, such as rent, which don't necessarily decrease when you reduce your volume. You have to make some estimate of what costs will be reduced by abandoning certain types of work. To do this, allocate fixed costs among the types of jobs you do. The goal is to break down all costs and expenses by responsibility. In what phase of business does the specific expense occur? You can find fault with any method of assigning these expenses because there is no totally accurate way to do it. Graham Construction Company profit and loss statement for the year ended December 31, 20%. Figure 8-1 profit and loss statement. Allocations are discussed further in Chapter 15. For now, be aware that no general method of assigning expenses is perfect. Direct costs are more easily assigned because with good records, you can identify the related area of income for each direct cost item, analyzing the relative profits. Figure 8-1 is a profit and loss statement for Graham Construction Company for 1 month. This builder splits his business into commercial and residential lines. Commercial work includes all bid contracts. Graham is a specialist in office building remodeling and generally has several large jobs going. The steady volume makes this type of work desirable. Graham's management knows months in advance what a large part of its income and expenses I will be. And because the line of business involves a few large contracts, the related costs and expenses are easier to control than in most other lines. The residential category on the Graham statement includes all material sales, repairs, and improvements, freight, hauling, and other work sold directly to homeowners. Graham Construction obviously does better with its commercial construction. Figure 8-1 shows that Graham might in fact be better off without the residential line of business. You can see that net profits for commercial work are $44,899, a 24.3% yield. Abandoning the residential business would save a large part of the bookkeeping volume, management time, and daily telephone calls. The Graham Company doesn't have a good method for allocating expenses. All expenses are assigned on the same basis as gross sales. If they would break out selling expenses separately as Johnson Construction does, it would be a more accurate way of allocating expenses. Graham realizes the shortcomings of its byline statement. For example, if operating expenses had been split on the basis of gross profit, the results would have been very different. But the Graham Company decided to analyze the effect of getting out of residential work by preparing the statement shown in Figure 8-2. Graham used conservative assumptions in preparing this summary. Abandoning almost half of the operation's volume seems to be a drastic move. The following estimates were made: office salaries, taxes, and licenses would be cut in half without the residential line. 60% of operating supplies and union welfare expenses would be cut. 25% of office supplies, insurance, and automotive expenses would be cut. These estimates are based on the builder's realistic appraisal of expenses in his operation. He also relied on his familiarity with his business. The problem Graham would face in leaving the residential market is apparent. Figure 8-2 shows that the 24.3% yield on commercial work in a consolidated operation falls to a 16.6% yield if only commercial work is taken on. This shows two things. First, the basis used for allocating operating expenses isn't as accurate as it could be. A better division would have been based on gross profit. But this is still only a broad estimate. Second, abandoning residential work wouldn't increase profits. While the residential work isn't a moneymaker, it does help carry the business overhead. Graham Construction Company profit and loss analysis by line of business for the year ended December 31, 20. Figure 8-2 profit and loss analysis by line of business. This doesn't mean that Graham can't afford to leave the residential market, but the move must be the result of careful planning. If Graham really doesn't want to be in that business, he must either seek out new markets to replace the residential business or settle for a reduced profit. Remember that the present combined yield is 10.7%, and the commercial line is estimated to yield 16.6%. In Chapter 7, I pointed out that a higher yield on volume is always more desirable. Graham Construction might want to consider phasing out of residential work as it replaces lost volume with more commercial work. A realistic goal would be to hold profits of $37,400 on a reduced volume. When the profits climb to that level, the company could consider abandoning residential work completely. The result should be a smaller volume of business with no cut in profits. At a profit ratio of 16.6%, Graham Construction would have to increase its gross to about $225,000 to reach $37,000 in monthly profits. This is about 22% more than the current volume. Actually, Graham's fixed overhead wouldn't vary, so an increase of somewhat less than this could bring the same results. Graham must consider whether it can increase volume 22% in a competitive market. There might not be enough work available at attractive margins in their market area. If Graham did decide to go after a bigger share of the commercial market, it should watch costs and expenses carefully during the transition period. You can calculate the required volume by starting with the monthly profit assumption, Figure 8-3 summary of successful volume. Here's how he calculated the estimated selling expense. There's one last consideration. Fixed overhead can increase or decrease with significant differences in volume. Going into new markets may require more rented space. More equipment and machinery would increase depreciation expenses. Some other expenses would probably increase as well. A decrease in volume might allow you to cut some fixed expenses. Figure 8-3 shows favorable volume increases assuming direct costs at 55% of gross receipts. Profits vary with volume and expense levels. Figure 8-4 shows unfavorable volume increases and illustrates what can happen when you don't control direct costs. Column E shows direct costs calculated at 55% of sales. Column H has direct costs at 70% of sales. This is the kind of trap that Graham Construction must avoid if they decide to increase their commercial business. The degree of success depends on how well they control costs and expenses. Figure 8-5 compares the yields for the favorable and unfavorable volume, increases in figures 8-3 and 8-4. The relationship between volume and profit. It's important to understand the relationship between volume and profit. You should recognize this relationship when you decide to concentrate your efforts in one market and abandon another. The margin of profit increases with volume if costs and expenses are a declining percentage of gross receipts. Without that advantage, the profit margin will remain the same with increased volume, or may even decrease. Controlling expenses means both keeping increases to a minimum and knowing what will happen when new markets are acquired or old ones are abandoned. With a reduced volume, Graham Construction would have difficulty maintaining its profit margin. Some of those fairly inflexible expenses would suddenly represent a much higher percentage of total sales. With a growing volume, it's easier to hold expenses to a lower percentage because those same fixed expenses are slow to rise at first. Summary of unsuccessful volume. Figure 8-4 Summary of unsuccessful volume. Figure 8-6 illustrates the relationship between volume and profit. A constant overhead expense represents a smaller percentage of sales with higher volume and a larger percentage of sales with smaller volume. In short, success in increasing the margin of profit depends on control of fixed expenses. Selling expenses usually rise in steps and are related to business volume. While selling expenses tend to follow sales volume, they're even more controllable than fixed overhead. Supplies, insurance, automotive expense, and office salaries can be budgeted and controlled. As volume and cash profits increase, some builders tend to relax their control over selling expenses. But you can only maintain the standard you have set for yourself if you keep them under control. Guidelines for dropping low-profit business. There is no precise way to allocate expenses among your various sales categories. Even the most controlled allocation method involves some judgment. Decide whether the basis you use for allocation is accurate by comparing the yields you develop for each part of your business. Figure 8-6 Successful volume and the margin of profit. Don't be too critical of seemingly low-yield markets until you calculate the effect of doing without that volume. Your true profit might be higher than you think. Like getting into a new market, abandoning a market requires careful research, planning, and analysis. Retreat from unprofitable markets, but only after you're sure they're truly unprofitable, likely to remain so, and are a drag on your business. Decide how to replace lost volume. The growth of your business depends on the availability of work and the competition for it. Know beforehand that you'll be able to take over enough of your market to make up for lost volume. And map out a plan for replacing abandoned volume. Include a volume goal. Begin with the profit you want and figure back to the volume you need. Then phase out of the old low-yield market and into the new volume you have budgeted. All through this process, carefully control your direct costs, selling expenses, and fixed overhead. Keep in mind the relationship between successful volume and the margin of profit. Control selling expense and direct costs as increases in volume occur. Check your yield from time to time. This is the best indicator of the effectiveness of your controls. Profit margins that remain unchanged or that decrease while volumes increase are the result of uncontrolled changes in costs and expenses. Be realistic. Don't play with the numbers just to make your plans work out to expectations. The purpose of profit planning is to come up with a realistic estimate, not to justify a foregone conclusion. Be willing to change your plan if your previous profit forecast doesn't work out. Remember, your market environment is constantly changing. Your planning needs to change in order to keep up with the market. Keep your original objectives in mind. There's no point in pursuing new markets you really don't want. After all, you're in charge and should remain there. When you find yourself doing things you don't want to do, ask yourself why you started your own business in the first place. Be wary of the concept of acceptable losses. You've probably heard of this idea, that it's okay to lose money initially because you'll make it up with future profits. That may be true, but it's better to start making profits right away, if possible. And few of us can afford 2 or 3 years of losing money.